Start recording. All right, welcome to October 30. This is the Eagle City Multifamily Show where we talk all things apartments and commercial real estate. And we have some amazing guests on today who will be presenting in just a moment. But before we get started, this is not legal or financial advice. It's simply professional sharing what we do. And it's all in an effort to let others know how you can become involved and in the apartment and the multifamily space. We feel like it's a great investment. It's been doing it for years, and you'll be hearing some great information. A little bit about Eagle City Multifamily. Asif Kumar and Dr. Sanjeev and Nikki are part of the Eagle City Multifamily team as well. And today we have some amazing guests, Nathan Allison and Mr. Sanders from the MMG brokerage firm. And I will let you guys take it away. Tell us a little more about who you are, what you do, and show us your presentation.
Thanks, Herb. Really appreciate it, and looking forward to talking a little bit about multifamily and the markets here in North Texas with everybody this evening. First off, want to introduce myself, Sanders Campbell with MMG Real Estate Advisors. We're a national brokerage firm based in Kansas City. Nathan and I are the North Texas team. We've got coverage throughout the Midwest, Southeast, and pretty much everything east of the mountains. Nothing out on the West Coast yet, but we're a quickly growing firm founded back in 2021. And talk a little bit about our national platform. One thing that we've found is that our national presence really allows us to have a finger on the pulse with what's going on in the multifamily markets. We have hundreds of conversations every day with multifamily operators, capital markets, debt, everything multifamily, how you build a capital stack, operators, management. So we're really able to get a finger on the pulse for what's going on in real time. And what that allows our clients to do is remain informed and be prepared to make the most informed decisions in real time with the most up-to-date information possible. And so, it's not just about telling somebody what their property is worth, but it's about educating them as to markets and market trends, and being an advisor and such that we're there for our clients throughout the entire process, not only identifying properties, but helping them along the way and getting their properties set for execution of their business plan. So today we're excited to talk about our marketing report for Q3, specifically in Dallas. But real quick, just want to introduce Nathan Allison as well. He is here in Dallas, work together, and so we're going to be taking the different sections throughout our report today and imparting a little bit of knowledge on how we see the markets. And first and foremost, as I'll share screen right here, you can see that our website, we take a lot of pride in it. Our research team dedicates hours and hours to really putting this data together in a way that's digestible and easy for everybody to understand. And we'll throw the link to our website in the chat, but you can see here through our screen, this is our homepage, and up here on the right, you can see the research tab. We're going to go into the research tab, and this is a resource for anybody and everybody to go visit. You can see we've got construction pipeline reports, market quarterly reports, blog posts, research, and analysis. So very, very good tool for multifamily operators to stay in the know about what's going on. So today we're going to be talking about the Dallas-Fort Worth multifamily Q3 report, and we're going to dive in right here. So high level, I'll just give you a little bit of kind of thoughts on what we're seeing here locally. Obviously, nationwide, we're seeing a massive, kind of slowdown as we have been after this epic run that the multifamily industry has been on for the last 7-8 years. And what we're really experiencing now is kind of a reversion to the mean, getting back to blocking and tackling, emphasis on management and operations, as opposed to just being able to go buy a property, hold your finger up to the wind, and you'll find a buyer for it 2 years later. So it's very important in this environment to operate properly, to really get your costs in line, and focus on operations. We believe that this is going to last probably through next year, through 24. And so there's a saying going on around the industry right now: it's survive till 25, and 27 is going to be heaven. So hopefully that's the case. There are a lot of headwinds right now, specifically in insurance and taxes and labor and kind of all the above. It's a perfect storm, but those prepared for the next 12-18 months, and those able to go out and make good acquisitions in the next 12-18 months are really going to flourish here in the next 3 to 4 years. So we'll dive in, starting off with a general overview. As you can see, our market reports are very clean, got a lot of really good data. So we're going to just start with the supply and demand general overview. What we're looking at is the DFW markets. So DFW regained demand momentum due to employment growth and increased migration. Everybody knows the migration story, coming from both coasts and the Midwest down into Texas. So that's really kind of supported the local markets around here and kept them relatively insulated to what we're seeing in a lot of the other markets that have just gotten too hot and the bottom's kind of fallen out. Year ending Q3 2023, the market absorbed 8,742 units. It outperformed 2022's net move-outs, but fell short of pre-COVID 5-year annual average, which was 21,000 plus units. On a sub-market analysis, the leading sub-markets were Frisco, North Fort Worth and Keller, Allen, McKinney, Burleson, and Johnson County. So if you're looking at that on a map, the way that looks is everything's going blasting out north. And Herb, I believe you guys talked a little bit about this last week, just the growth story going all the way up to the Oklahoma border. Allen, Sherman, Salina, you're really seeing that growth go up north. And a lot of that has to do with the infrastructure and transportation. You've got, 4 major veins going out north of Dallas that have just made it very easy for people to come back and forth to the Metroplex, and communities really starting to be developed out north. Going south, you're not really seeing any of that going south out of Dallas just yet. I believe that there is a long-term growth story there because people are going to have to grow somewhere, but the Dallas is still a little bit muted going south. But Fort Worth, on the other hand, there's a lot of growth going south out of Fort Worth as well. You've got the toll road going south, which has been a really good kind of vein to open up that growth going out south of Fort Worth. So your Burlesons, your Cleburnes have really seen great growth, over the last 12 months. So general matching of demand with the new supply across the 48 Metroplex submarkets. And that's an interesting fact because we do have one of the highest, and you can reference this in our construction pipeline report, but we do have one of the highest deliveries of multifamily units being delivered here over the next 12 months. But the interesting part with all the immigration and growth here is that a lot of those units are going to be absorbed successfully. So the growth story is still very real, and not a better place, arguably, than the DFW markets to be an owner operator. So talking completion trends, the year end, third quarter 2023, metro-wide inventory expanded by 25,386 units. It's roughly matched the average annual addition of the past 5 years. The Dallas, Plano, Irving Metro Division accounted for 67% of Metroplex deliveries, and that represented about 17,000 of those units. As far as demand, the demand outlook, the anticipated demand, the upcoming 4 quarters, project absorption of 52,800 units. That's outpacing the estimated new supply I referenced earlier of 49,046 units. So we're right there with demand meeting the supply deliveries. So the significant demand centers, as we're talking about that growth story going out north, Allen and McKinney, the projected annual absorption rate is going to be 6,570 units. And then Frisco, projected annual absorption rate of 5,847. The new supply outlook, the anticipated new supply upcoming 4 quarters mark a peak period for new apartment delivery. It's going to be, like I said earlier, 49,046 units. And the significant supply boosters, again, Allen and McKinney, and Frisco. So those are really the two kind of major suburbs. And I don't even know if you call Frisco a suburb anymore, but those are the two big demand drivers as we go out north. We've got that, and now we're going to be talking a little bit about occupancy and rental trends.
Yeah, thank you, Sanders, and thank you, Herb. As far as occupancy goes, in DFW, we saw a decrease to 93.4% in the third quarter. That was down about 1.6 percentage points from the previous year. This rate, while lower among the nation's top 150 markets, remains close to kind of the long-term average that we've seen around 94%. In the third quarter of 2023, most submarkets had occupancy rates below 94%, with the exception of some quieter suburban areas and the outer urban areas. If we want to look at it by asset type, occupancy rates kind of break down as follows. Class A properties were at 93.8%, Class B at 93.3%, and Class C, which is going to be your more affordable segment, was at 92.9%. From a rent standpoint, in the year ending third quarter of 2023, DFW saw a half-point decrease in new lease rents. This decrease was consistent in both the Dallas and Fort Worth metro divisions. Within the market, the changes in effective rents for different classes were as follows. Class A properties experienced a slight dip of 0.1%. Class B rents fell by a whole percentage point, and Class C properties actually saw a slight increase of 0.3% in their rents, despite the drop in occupancy we talked about. More than half of the 48 submarkets here in the Metroplex observed rent reductions, ranging from mild to moderate throughout the year. And the outer urban submarkets, as I mentioned earlier, kind of recorded the most significant rent growth.
All right, good deal. So now we're going to get into the transactions, and that's what we all like to see in here as operators, is the sales activity. So the transaction activities in 2023, the overview, it's been consistent pace and transaction activities in the Dallas market. Real Capital Analytics reports approximately $3.1 billion exchanged for 88 transactions here locally. The comparison and trends, there's a decline in transaction volume of 64.6% compared to the previous year's same time frame. Comparative nationwide we're down about 80%. So that shows that the DFW market was the, if not the most active market in the nation as far as transactions went. Despite the decline, Dallas remains a premier market and cumulative sales volume nationwide. Average price per unit was $188,800, indicating a 4.4% contraction from the preceding year. Just to talk a little bit about what we see and talk with our clients as we're doing valuations and strategic analysis for them. We're seeing valuations come down by about 20 to 25%. There still is a buy-sell gap. Sellers' expectations are still a little bit high, but we are seeing those start to come down. To be quite frank, we're having a lot of hard conversations right now and telling owners what their property is now worth. It was a lot easier 3 years ago when you told them it was going up and up and up and up, and right now we're headed the other way. But we do feel that we are approaching some sort of a bottom. You can never time a bottom, but it definitely feels like we are probably in a place where those who are prepared should be prepared to start buying again. So we're now getting into the discounted transactions if you're prepared to go out and make good purchases. The factors driving investment in Dallas Metroplex are the economic and demographic dynamics. Being compelling economic and demographic dynamics, they contribute to the market attractiveness, right? Dallas is a really good demographic. It's not an energy specific Metroplex. It's very it's a wide variety of different industries. We've got a lot of headquarters moving here nationwide, and that's not just one specific industry. It's all sorts of industries. Texas being a very business friendly state makes it very attractive to do business. So we're like we're talking about, and that'll be the common theme, is the in-migration and economic environment being very favorable for business and specifically for multifamily segment. So the low entry barriers and robust fundamentals are another thing. It's a significant draw for investors. We have a major supply and one of the biggest supplies of multifamily units in the nation. So while it is a little bit intimidating to come into a big market like this, there is still a lot of opportunity. There are a lot of groups such as ourselves out there, like I said, that are talking to owners each and every day. And so for you guys, I would encourage everyone here to really reach out to your local sales advisors first. Obviously, MMG should be first on the top of your list. It's a shameless plug, but no, I think kind of like I talked about earlier, we really do have the best finger on the pulse. So we're the ones that are out talking to owners, sniffing out deals. So going direct to owner is one thing, but it can be a little bit daunting. So definitely rely and lean in on your local advisory groups to help you identify and locate those possible transactions and opportunities. The investment trends and projections. Historically, Dallas Metroplex has witnessed unprecedented capital investments over the past decade. We've all seen the growth story here. We know, why everybody wants to be here, and then we fully expect that to be sustained. Everybody that we talk to nationwide is always asking, we'd love to get into Texas, but we just feel like we don't see the opportunities to do so. But I can tell you, loud and clear that we're here and we see a lot of these opportunities here locally. So the market is alive and well here, although it is a different market. With that, we'll move on to the next section, and that's going to be regarding the local economy.
Yeah, so in regards to the local economy, the top 5 employment sector had a pretty good annual change. Sanders, if you want to hover your mouse over each one of those professions, you see trade, transportation saw a 2.6% change. Business was in the mid 5s, low 5s rather. But yeah, in regards to the economy, the third quarter of 2023, Dallas, the whole region experienced significant economic growth. A 2.5% increase in GDP, or gross domestic product, was absorbed in DFW. The addition of 178,600 jobs reflected a 4.4% rise in employment. In July alone, the unemployment rate was, in July, the unemployment rate was 3.8%, which was slightly above the national average. Job growth was led by the professional and business service sector, which added 39,100 positions, marking a 5.1% increase in that sector. The trade, transportation, and utilities sector also saw growth, adding 23,200 jobs at a 2.6 annual increase. Despite initial job losses caused by the pandemic, the current employment base now exceeds the pre-pandemic levels from February of 2020 by approximately 339,600 jobs, which, if you go back to pre-pandemic, is about a 12% increase. The Dallas metro area is home to the headquarters of 22 Fortune 500 companies. So definitely keep that in mind as people return to work. That's going to be a big driving factor. And it has a really strong corporate presence in key areas like the Dallas Central Business District, Dallas North Tollway Corridor, and Las Colinas area has a lot of good jobs there as well.
Good deal. And just as a side note, you can in these reports you can go in and you can start diving in by sector, submarket. It's a very dynamic report, so I'd encourage everybody here to make sure to go and follow up after this meeting today. Go ahead, Herb.
Sanders, anyone can go on your website and look this report up, right?
That's exactly right. So if we haven't already, we'll throw this in the chat, and feel free to throw this on the on the channel as well when you get this up. You know, anybody can go on just the research section of our website and access all these reports. And that's not just for Dallas, that's for our entire coverage nationwide.
Thank you. Awesome.
Talk a little bit about cost of living, how it compares. You know, this is, like I said, the trend of people moving from California. So this comparison here is going to talk about the comparison of living in Dallas versus living in LA. You know, the Dallas Metroplex's cost of living indexed at 102.9, slightly above the national average. The housing affordability here, though, is 98.1, indicating that the housing market is more affordable. The median home sales price in the Metroplex is $398,800. Comparison with Los Angeles, the cost discrepancies, Dallas versus LA, the housing costs in Dallas are 59.5% less expensive. So you can see when people sell their houses in California, they get a lot of bang for buck here. And that's actually done a lot to support the housing market here, right? You know, people coming in and just blowing offers out of the water, and just being able to, you know, pay what they're looking at as a significant discount to what they are in California. Yet it's really setting the bar high here and setting a lot of records for home sales here in the Metroplex. Transportation costs in Dallas are 30% lower than LA. You know, like I said earlier, the financial attractiveness, it's a very business friendly area compared to California. So that's kind of some of the comparisons that we see between the two. Generally, the market outlook, and this is kind of going to wrap it up, and we'll talk a little bit about this, but then we can dive into some Q&As at the end, and I've got a couple more thoughts I'd like to share as well. You know, the completion figures for multifamily around here, there were, like I said, 25,386 units completed so far this year, and it leads the nation in new apartment supply. But again, that is going to be absorbed with all of the migration, with all of the economic prosperity going on here, and just the insulated nature of this market. We're really keeping up with all of the supply coming online, and there's a, you know, a significant point with, we don't have enough time this evening naturally, but the construction going on right now, the construction starts have virtually ground to a halt. So you're not going to see a lot of new starts here in the next 12 months. And what that means is the supply that is due to come online will come online. But once those are all delivered, there's not going to be a lot of new supply coming online. And what that means is that we're going to be back to an environment where operators can really start pushing rents again, just because it's going to be a competitive environment from an operator standpoint again. And you know, operators aren't going to have to worry about somebody next door to them building a brand new apartment complex and not being able to push rents as aggressively. So you know, like I said, survive till 25, and then once the new construction pipeline, like I said, grinds to a halt, there's no more deliveries. It's going to be a really good market again. But what that does mean for the people that are able to get construction financing for new projects off the ground in the next 12 months, they're going to be the only game in town delivering, you know, new product to market. So you know, they're going to be in a really good position as well. So I think it's going to come back to a relatively balanced market, and very favorable for operators at that time. So I think generally, another trend that we're seeing, kind of going back to what the experience has been over the last 18 months, is we're seeing an expansion in cap rates, right? So a couple years ago, you know, everything was trading with a 4 handle on it. So that means that, you know, your Class Cs, your Class Bs, and your Class As were all on top of each other. And there really wasn't much discrepancy across the asset class. Over the last 12, 18 months, we have seen an expansion in that. The Class A properties are trading, you know, I still see a few that have a 4 handle on them. That's assuming they've got possibly a really good and attractive assumable debt that can be carried along with the acquisition. But your Class Bs are moving into the low to mid 5s, and in some instances the high 5s. And then as you get down into the Cs, we're starting to see and underwrite a lot of deals at 6 caps. So the market is kind of coming back to where it's been for the last 15 years. You know, it's back to the norm. This is a new normal. But it's, it's going to be a matter of time before it all kind of comes back again. So the theme here again is, operate well, make sure your house is in order now. If you're able to go out and make good acquisitions right now, the next 18 months are going to be very crucial for when the markets come back, because anybody that's got a nice portfolio at that point will be in a great position to realize that equity and continue on. The people that are transacting right now aren't necessarily just distressed owners. It's people that have owned an asset for the last, call it 7 to 10 years, and they've executed their business plan. They've done everything that they thought they were going to do. They've probably refinanced once or twice already, and so they're sitting on a nice asset right now, and they see what's coming in the next 12-18 months, and so they're taking their assets now to market to realize that equity and be prepared to make a discounted purchase for something, and kind of get their basis back down low. So they're the other type of people that are transacting right now are people that transact in any cycle, at any part of the cycle. There's this line of thought that if you can transact throughout the entire cycle, you'll cost average to a place. As long as you're operating well, you'll cost average to a place where you're going to continue to make money throughout any cycle. So as far as the distress side goes, from a transaction standpoint, a lot of the distress that everybody was expecting and some people hoping to come to market really hasn't made it yet. That's because they're able to work out with their lenders, with their equity providers, their LPs, whatever that may be. They're able to get it worked out before they have to go fire sale their assets. So we're not really seeing any fire sales happen. There are going to be some. We've seen some that have made headlines. Those were unfortunately people that just over leveraged and put themselves in a poor position financially when they purchased at the top of the market with super high leverage back in 2021. So that's I've done enough of the talking. So I'm happy that we're able to share this with you guys today. Hope everybody was able to take something away from it, and love to open the floor up for some Q&A.
Thank you, Sanders and Nathan. And you already touched on one of the questions from the audience as far as what type of sellers that you're seeing now in the market. And you touched on some of that already, right? Mm-hmm. Why are they bringing things to the market? Are we seeing distressed properties, right? Distressed owners, I should say, right?
Yeah. Operators
to the market. But you already touched on that one very well. So
yeah, I think that, just to kind of make another point there, the people that are distressed right now, this is a lot of these syndicates, groups that maybe weren't around for the last down cycle, the last downturn, weren't necessarily prepared. And when people were underwriting, nobody was underwriting 100% tax increase and a 100% increase in insurance, right? It just you couldn't go be competitive in a sales process to buy something if you were underwriting to that. You just weren't even going to be in the hunt to make that. So unfortunately, people did get kind of caught holding the bag a little bit, but those folks, they're kind of kicking the can down the road right now. If they don't have a rate cap expiration coming, and they can, extend, they might be in a 3-1-1, which means they've got a 3-year term on their debt with 2 1-year extensions. They may be, exercising that first-year extension right now, knowing that they've got another year to go beyond that. And so they're just hanging on. They're not making distributions to their investors right now, but we are seeing some people kind of really be prudent about getting their affairs and books in place to where they can survive over the next 18 months.
All right. Thank you, Sanders. And we'll open this up for anyone live on the call to ask questions. You're welcome to come off mute. I know there's some attendees that if your camera is off, we can't see you. So turn your camera on, unmute yourself, ask questions. We have the professionals on with us right now. So now's your chance to ask questions. Feel free to post your questions in the chat as well. And I want to recap just a couple things that I heard throughout your presentation as far as the Dallas and Fort Worth areas, Fort Worth is hot markets, like moving south of Fort Worth on some of the corridors there, and also Dallas. The hot markets are moving north, right? There's some really hot markets north of Dallas. We have several large corridors going north out of Dallas, and a couple other things. The cap rate is expanding, right? And the Dallas Fort Worth is home, I heard you say, of 23 or 24 of the Fortune 500 companies, right? So that's a lot of major employment, as along with all the other large employers in town as well. So those are some great reasons we invest in the Dallas Fort Worth area. And so please ask your questions, come off mute, post them in the chat any way you like. And Sanders, you say you have a couple other points as well.
Yeah, those were just kind of my my finishing points, was to talk about cap rate expansion, and you know, kind of going back to leaning and operating in this environment. You know, I think it's very important to know where you stand in regards to the marketplace. You know, and this is whether you guys decide to you know, call us up or call somebody else up who you have an existing relationship with. I would encourage everybody to just really keep a finger on where your asset is in regards to the market, and that may mean you know, getting a living, breathing BOV you know, in place where you can continue to get updated financials over to your advisors or your trusted you know, folks, and as long as they can keep you in the loop about what's going on and what your property's doing in regards to valuation against the marketplace or the submarket as a whole, it'll really allow operators to be prepared to make the decision when and if the time comes, whether it be a refi or whether it be taking it out to market or what have you. But just sitting in the pot and watching the water boil around you is not the best way to do it. And so you know, just really staying on top of it and leaning on your local advisors, leaning on the folks that can take some of that burden from you. I mean, you know, you guys spend so much of your time operating your properties and operating them well and putting a ton of thought into creating the cultural experience at the property level. You know, really lean on groups like us to help you understand where your property sits on a not only a market level but a national level as well. And so I would just encourage everybody to make sure and reach out and consider that moving forward as a resource and a tool. I mean, you know, if you can, the more experts you have around you, the better informed you'll be.
Absolutely. Thank you, Sanders. And would you mind telling us just a little bit more about like what all you do? Are you listing
Sure.
properties? Are you, I know you talked about for our listeners, right? Talked about the advisory role you do.
Absolutely. You know, right now, as we know through the marketing reports, there's not a lot of transactions taking place, and so we really take an advisory approach to a client relationship, and that what that means is getting a feel for where you are currently, where you want to go, and how we're going to get there, right? So understanding where your thought process is and was when you acquired a property. You know, what your plans were. Was your plan to possibly hold this for long term, put it in a trust, pass it down to your kids? Was this a scenario where you wanted to buy it, implement a value add program of, you know, 25% of the units and then get it prepped for somebody else to come in and take it the rest of the way and sell after, you know, 2 to 3 years? Is this something where you want to build a portfolio of you know, a few thousand doors and then sell it as a portfolio? or possibly take a private REIT, or what. There's a lot of different avenues. And so really understanding where our clients' business plans begin and what their goals are for their company and for their business is the first step that we take. And so once we understand that, we then go to the property level and we understand how each property is performing. We do that by creating what's called a strategic marketing analysis. We'll take all of the local data, we'll take all of the property level data, and with all of our research and all of our resources, and create a strategic analysis that we'll present and show our findings on that. And then once everybody's on the same page, once we know what your original plan was, where your properties currently sit, and what your eventual goal is, we stay in touch throughout the entire process, and we're really able to, give monthly updates. Maybe there was a bump in occupancy, or maybe there was a drop in occupancy, and we can keep an eye on that. Not only at the property level, but kind of say, okay, well, we are seeing this market wide. Here's how we're seeing it from a macro trend, or maybe this is a property level issue with management, and we can make introductions to other management companies that we might recommend, or hey, we've had a lot of conversations with insurance companies right now, and we want to make you prepared for the expectation that insurance prices are about to go up. So a lot of the information that we find in real time is information that we share with our customers and our clients to make sure that expectations and there aren't any surprises along the way. So that's really the advisory approach. And when and if the time comes to sell the property, we're then able to have everything ready to go. We know an intimate knowledge of the property already. We take it out to market. It's not just, for example, a local list of 50 buyers that we know here in the Metroplex. It's our national team really pulling in capital from other markets. An interesting stat, Herb, is all of our listings have had an average of 80% of the bids being from outside of the local market. So these are a lot of national owners, for example, wanting to get into Dallas, or wanting to get into Kansas City, or wanting to get into Northwest Arkansas, that have never purchased there before. And so what we're able to do is we're able to, have an intimate knowledge of not only you, the client, but of our national clients as well. So we know a client in, let's say, Des Moines, Iowa, for example. We know that they like Class C value add, 1990s, the certain personality of a deal that they're looking for. They may not know anything about the Dallas markets, but because of our national presence, we're then able to say to that owner, hey, what do you guys know about Dallas? We've got a property that we think would be a perfect fit for you guys here. Maybe this is something we should educate you and bring you up to speed on. There's a perfect example of that happened with a group in Northwest Arkansas. They ended up being number 3 in the bid matrix. They didn't get the deal. They were the bridesmaid on the deal. And we introduced them to our Kansas City team and educated them about the market. And now I think they own 3 or 4 different properties in the Kansas City market. So the national platform that MMG has created has really allowed us to bring not only capital across markets, but also create a very competitive process when we take out properties at the end of the transaction. So it's kind of an entire continuum, not just transactional. It's a very advisory approach.
All right. Thank you, Sanders. That's very valuable information. And we'll be wrapping this up in just a moment, but any other things, Nathan or Sanders, that you would like to say to us, to the audience? Anything from the audience? Any questions? Please bring them up. Last chance, right? It's been very entertaining, and a lot of valuable information there you're sharing. So we were really trying to close on a property before the end of the year. We're getting probably past that point by now, right? Be hard to get a property under contract and close this year yet, but we're definitely looking for like 60 to 150 unit deal in the markets that we've been discussing. So
yeah. Well, that's good to know. And you know, we're happy to get you guys plugged into our pipeline and start showing you deals and opportunities that we see. And you know, beyond that, most importantly, just be a resource for you and your group for any of y'all's needs. You know, we're here for you guys at the end of the day. And you know, when you win, we win. So that's what it's all about.
Thank you, Sanders. Nathan's been sending me some deals off and on, so he's good. So
Good.
connection there.
Good deal. Good deal. And I would say, you know, anybody on the call, anybody watching this now or in the near future, don't hesitate to reach out. Herb will share our information. And, you know, again, happy to be a resource for anybody here. And look forward to a bright future. Just hang on a little longer, and it's gonna all come back here in the next 18 months. So.
Oh, absolutely. All right. Okay, well, thank you so much for the information you shared with us in our group. And we'll wrap it up here and see you next week. What we have planned for next week are some of the deals. We're going over a list of deals that we've been looking at throughout this year, and reasons that we turned some of the deals down, right? Didn't win some of the deals, right? So that's what we'll be going over next week. So everyone feel free to join next week, and we'll see you then.
Thanks, Herb. Really enjoyed it.
Yep. Thank you, Herb. Thank you, team.
I will stop the recording.